investing based on price movement, and we saw that as quite detrimental and quite worrying, and saw it as a powerful tool to be able to give people understanding of the technology, and really assist them to make the best of their own investments. So over the last few years, we've been deeply involved with the crypto and blockchain space, both here in Australia and also globally, doing some advisory for different blockchain projects, and are now primarily focused, like Joe said, on tax reporting for cryptocurrencies and streamlining things for individuals as well as their accountants. So today I'm going to speak a bit on that experience, explore the taxation case for you guys over in New Zealand, and give you a few key tips to ensure your own tax compliance and hopefully give you the comfort to invest knowing how the taxation will work at the end of the day. So the taxation of cryptocurrencies varies across the globe, as I'm sure you would have heard the hot topic across all the different jurisdictions globally. They're all coming up with slightly different interpretations, and it does make for quite a confusing global market because each of these interpretations being slightly different, not necessarily knowing exactly what to do in your own jurisdiction because you hear all these different things. So I'm here to give you the hard line of it, and in New Zealand for you guys, cryptocurrency is considered a CGT asset. You may read that it is treated like property. That's the other words they might use there. Treated like property means that it's a capital gains tax asset, and you basically need to pay capital gains tax upon the disposal of a cryptocurrency. So we can see here in this example, when we have got some Bitcoin purchased a while ago, whenever, and we then want to trade it for Litecoin, we're going to have to pay CGT on that, and the amount of capital gains that we'll pay is the difference in the value of the original purchase price of the Bitcoin and the value of the Bitcoin when it was then traded for the Litecoin. So that difference in price over that time period is the amount that you'll need to declare as capital gain, and that is required for every time you dispose of a cryptocurrency. So we can see here after we move from Litecoin into Ripple, again, the difference between the value of the Litecoin at the time it was first acquired and the time it was then traded, that is the capital gain, and the same goes for when you convert it back to fiat. So the capital gains here must be calculated and declared on every single disposal, including crypto to crypto, and not just when you are transferring back into a fiat currency.
Awesome. So just really quickly to clarify for the guys on that mark, if you bought Bitcoin at 10,000, it went up to 15,000, the taxable or the CGT event is on the 5K profit that you've gained.
So it's like a percentage of the gain.
Exactly, it's 50% in the first 12 months, which I won't get into because I know Mark's going to talk about that, but just to clarify the point of how the crypto works.
So in that example, obviously, there's that 5K difference in the value. That's the value of the capital gains that you'll declare, and then you'll actually pay tax based on your own tax bracket, based on your income. So the actual percentage you pay in the end will depend on your income, but that's how it's calculated. It is by that difference in value. So purchases are obviously not at disposal, so we don't need to consider any taxation when we're first acquiring some crypto, such as buying some Bitcoin with your New Zealand dollars. Transfers are also not at disposal. So if you're sending a crypto that you've purchased on an exchange like CoinSpot shown here, and you want to transfer it to a hardware wallet of your own keeping or a different exchange wallet, any other location that's under your control, you're going to pay no tax on that. And that's the same as if you're transferring from one wallet to another. So it doesn't matter if it's a physical wallet or it's a digital wallet or an exchange wallet. If you're transferring between locations that you're in charge of, there's going to be no tax applied to those cases. So the main thing here to remember is that the capital gains must be paid on every single disposal. So it needs to be calculated at the time so you know what sort of tax position you're going to be getting into, because the main problems I see are people not really considering at the time, and then come tax time, there's all of these trades they've made and they just had no idea of the summation of all of those capital gains. It's quite often sometimes being a larger amount than they expect. So the takeaway to remember is that capital gains tax must be paid on every disposal of a cryptocurrency. And this leads to some challenges. So if we look at the single asset life cycle, where we potentially buy one Bitcoin for $10,000, we might then send that Bitcoin to a hardware wallet for safekeeping, where we decide to maybe keep half of that and then send half of the Bitcoin on for further trading to an exchange shown here like Binance, where we then sell that half a Bitcoin for 10 Ethereum, and then send that 10 Ethereum back to CoinSpot and sell it for $7,000 fiat. So we can see here, we've only made a transition from Bitcoin to Ethereum, so not a particularly complex case necessarily. Sometimes there might be hundreds of more steps in this process. However, we can see already it causes challenges because we need to know what price was paid for that 10 Ethereum. In this case, we can trace it back and see that the half of Bitcoin was, one whole Bitcoin was $10,000, therefore the half Bitcoin was 5,000, therefore the 10 Ethereum was 5,000. And when we sell for 7,000, so we can see there's that value increase of $2,000 between the price paid and the price sold for. So this is a relatively simple example, but already we can see how tricky it becomes to track the cost basis of these different assets we've purchased in order to actually calculate how much tax is owed, because once you get into hundreds and thousands of trades, there's a vast sea of data to basically track across, and you need to have a complete picture of every data set, right? So you need to combine the data from the different exchanges, the different wallets you own, in order to actually extrapolate that into a capital gains calculation. Some of those, so go on.
I have a question there. Like you say, if I sell half of Bitcoin and then I bought 10 Ethereum, then I sell that 10 Ethereum for 7,000, then the gain is $2,000. That's right?
Yeah.
Okay.
Yeah.
But that's based on the Bitcoin purchase money, not on the exchange between Bitcoin and Ethereum.
Correct. So it's actually traced back to the price you paid for the original asset.
Oh, okay.
So not the price at the time of the trade here for the 10 Ethereum. It's the price that it was you actually paid for that asset, and then the price that it was worth when you sold it for the 10 Ethereum. So here we cash out to the 10 Ethereum ends up being worth $7,000. So we need to here in this case figure out how much was originally paid for that 10 Ethereum. So we trace it back. We see that paid for that 10 Ethereum was 0.5 Bitcoin, and then we trace that back and we see that $5,000 was paid for that 0.5 Bitcoin. So we can connect the start point all the way to the end point and see that there was a gain of $2,000.
So you only, like the calculations are only related to the cash that you, or the fire money that you spend with the fire money that you get.
Yeah.
Like suppose that after that Ethereum you buy Litecoin and then you sell Litecoin and buy Ripple and then again Bitcoin and then again, and I don't know, 100, you need to track down all the way up to the first original transaction where you spend your money. Okay.
Correct. So you need to, that's the challenge that arises is you go and you make all of these different trades, and each time you do, you have to trace back to the original value that you actually paid for it.
Yeah.
And you can see how, if you take that one Bitcoin and you buy 100 different coins with it, and they're all different values of that one Bitcoin, you might have 0.1 Bitcoin, you might have 0.0005 Bitcoin, all these different amounts. And you have to be able to trace that back to how much was that worth when I first purchased it.
Yeah.
So that's quite challenging as the data set increases in volume. And this is actually something that my company's been spending a lot of time working on. So we've created a process that uses software to collect the client data that we work with. And then we basically aggregate it all together using software. So our software can immediately tell in this last example, it can tell immediately the price that you actually paid for this 10 Ethereum. So when you sell it, it immediately can calculate that gain. Very difficult to do manually, and we've built a custom software process to make it easy. And we basically, follow this 3-step process to collect your data, use software to provide the relevant reports, and then we engage with a lot of accountants on the other end to make sure that they can actually factor those numbers into your tax return. So from this experience, we've learned a lot about obviously the taxation of crypto in different jurisdictions, as well as some of the traps to avoid. So without further ado, I'd like to share with you my 3 key tips to ensure compliance that I've sort of come to understand over the years doing this tax reporting. So the first one is just to keep things simple. Use reputable exchanges with good data access. So I've shown here 2. Independent reserve is probably my recommendation for you guys in New Zealand. They've got low fees and you can trade natively with New Zealand dollars. And the other one I've shown there is Binance, because they're actually a Chinese exchange. However, they're very reputable and they have a wide range of coins. So the reason I say keep things simple is too many clients I've seen rush and set up exchange account after exchange account after exchange account, and all of a sudden they're trading on 5 or 6 different exchanges when really they could have got the same purchases only using these 2 I've shown here. So the more different exchange accounts you set up and start doing trades on that account and then another account, it becomes increasingly difficult to keep track of all of that. And at the end of the day, someone like myself, or whether you're doing your tax individually, the more exchanges you've traded on, the more data sets, the more complex the process is basically how it boils down. So I highly recommend just keeping things as simple as possible. I understand there's times where you might want to purchase a certain coin and you can't find it anywhere else. I'm not saying, avoid setting up an exchange account to make that purchase. I'm simply saying make sure that you think things through and don't go setting up, heaps of exchange accounts when really you might not need them. So, find the set of accounts or the set of exchanges that works well for you. And I personally highly recommend, a combination like shown on the screen, where you've got independent reserve for your initial purchases, where you might purchase Bitcoin or Ethereum with your New Zealand dollars. And then you've got somewhere like Binance, which really you can send that Bitcoin or Ethereum and trade it for any number of the thousands of other coins out there. So really with the 2 shown here, there's not many coins that you can't get exposure to. So keeping things simple from the get-go will certainly help you keep track of everything come tax time.
So the guys over here, the most common exchange is Easy Crypto, which is a big exchange here, and what you're about to say next, I will certainly question the guys on and question Easy Crypto on as well, with the can you get a tax report and things like that. Because if you can't, then it makes it a very difficult ball game, and I'm sure they do have that downloadable CSV file, but if they don't, then that's something that they need to get done yesterday. So
absolutely, that's obviously what I'm leading. Easy Crypto may be a good choice. So let's be back here. Reputable exchange of good data access. So as long as you can sign into the exchange like Easy Crypto and actually download very easily a report of all of your transactions, deposits and withdrawals, that's what we're looking for. As long as you can access all of that data and you can also extrapolate it from the exchange, that's basically the conditions. If they can meet that, I'm pretty happy that they're reputable. Obviously, you need to do your own validation of how big they are and whether they're actually a valid exchange based on volume and things like that as well. But the main point here is make sure you can get the data out, because I've seen a number of exchanges that people have signed up for, and these are reasonable sized exchanges, mid-tier, and they can't get certain parts of the data out whatsoever. And that makes it really tricky. They can maybe view the data, but they can't extract it. So a lot of those cases, I'm basically manually recreating the tax trades based on screenshots and things they send me. It all gets very messy. So really an exchange is just not reputable unless you can access your data and extract it. It doesn't have to be a capital gains report or anything, but simply just access of your transactional history as well as the deposits and withdrawals. That's what you want to check for. So Easy Crypto, I'm not sure off the top of my head whether they have that functionality, but I will certainly be looking into it after this for future.
Awesome. Cheers, Mark.
So the second key tip is to keep smart records. I say smart records because assuming you've used reputable exchanges like I've recommended in step 1, you will be able to download that data and have a really clear, concise record of all your trades, all your purchases. And so really the main ones that you want to make sure of is when you're moving money from one place to another, when you're, for example, extracting some crypto from CoinSpot, Easy Crypto, Independent Reserve, whichever place you might have purchased it originally, and you're shifting that for safekeeping to a wallet address. That's when I would make really clear note, here's the date, I've moved 10 Bitcoin off of the exchange to this wallet address. And that's the stuff you keep hard, notebook copied notes on, because that's the stuff where people can potentially lose track of where they've sent some money and end up losing assets essentially. So it's really important to make a record of when you're actually moving things from one place to another, because assuming that you've used good exchanges and good wallets, the internal data or everything done on that platform will be really well recorded. And the only things that you really want to make sure is tying those different points together. So whenever you're shifting assets from one place to another, I would recommend keeping a really good, hard copy notebook, or that's my recommendation, is to keep it completely off your computer. Write these things down into a dedicated notebook. Not that leaving that information on your computer is overly exposing,